It is time to reevaluate absolutely everything you thought you knew about investing and your own personal risk limits. Today, we're diving deep into this explainer to uncover the true meaning of risk. For so many of us, investing feels like walking a tightrope, right? And figuring out exactly how much risk we should be taking on is, hands down, one of the most stressful parts of the whole process. But what if the way we've been taught to think about risk is fundamentally flawed? Well, let's unpack the source material and build a crystal clear understanding of how to actually approach this.
So a lot of folks ask about their risk-taking capacity like it's some sort of hidden number just waiting to be uncovered on a spreadsheet. We tend to think there's this magical formula out there, and if we just punch in our age, our income, and maybe answer a few multiple-choice questions, kind of like a superficial magazine personality quiz, the perfect percentage is just going to effortlessly pop out at the bottom of the page. But treating risk as a simple, static, numerical output, that is a huge mistake. The reality is, true risk-taking capacity is not a measurable test score you can figure out in a 5-minute online quiz. It's actually an ongoing negotiation. It's determined by a really unique combination of the cold mathematics of your financial life, your human behavior and psychology, and crucially, your actual lived experience in the markets. What this really means is that any successful asset allocation strategy has to satisfy two entirely distinct conditions at the exact same time. On one side, we have the math. How much risk do you genuinely need to take to hit your goal? But on the flip side, we have the psychological reality. How much risk can you actually withstand without panicking? If your financial plan only answers the first question and totally ignores the second, it is a ticking time bomb. It is literally destined to fail the minute the market gets choppy. Okay, let's start with the logical side of the coin first, which is defining exactly what you need to achieve your goals. This is step one, and it is entirely numbers-based. Think about it. You wouldn't start driving a car across the country without knowing where you're going, right? Investing is no different. You cannot possibly figure out an appropriate ratio of equities to debt without first plotting out the exact coordinates of your financial destination.
So before you even think about your equity to debt ratio, you have got to define your key numbers. What is your ultimate target amount? What's the amount required based on your current portfolio value? What is your target year? How much can you realistically invest every single month? And what return do you actually expect? Because without nailing down this specific information, any asset allocation ratio you come up with is just a personal opinion. It's not a strategic plan.
Now, if you run the math and it shows that your savings rate is low, but your target horizon requires a huge payout, you might initially think, well, my only option is a highly aggressive portfolio. But actually, you have other levers you can pull. You could increase your savings rate. You could delay your target horizon. Or you could adopt a more growth-oriented strategy. Or, hey, even use a combination of all three. And this right here is exactly why doing your financial planning has to come way before you decide on your asset allocation.
All right, let's flip over to the other side of the coin and honestly test what your emotions can handle. This is the behavioral aspect of the true meaning of risk. It's super easy to be brave on paper, sitting in a comfy chair when the market is booming. But behavioral finance tells us over and over again that human beings feel the pain of losses way more intensely than the joy of gains. The gap between theoretical paper losses and real-world panic, the sweaty palms, obsessively refreshing your portfolio app, that gap is massive.
So let's make this real. Imagine checking your account and seeing that a full quarter of your hard-earned wealth is just gone in a single year. How do you react? Do you just log out, take a deep breath, and stick to the plan? Or do you lose sleep, feeling this burning, overwhelming urge to sell everything just to stop the bleeding? Think about that for a second. Or what if you have to endure half a decade of totally stagnant growth while you're just waiting for the math to work out? 5 years is a brutally long time to be patient when you feel like you aren't making any progress whatsoever. It's mentally exhausting, and honestly, it tests your conviction in a way that a quick short-term dip simply does not. And then there's the invisible, completely crushing pressure of FOMO, the fear of missing out. Can you stomach it when your friends are at a barbecue loudly bragging about their massive short-term gains? It is incredibly difficult to stay the course with a balanced, sensible portfolio when it feels like literally everyone around you is getting rich quick.
Similarly, what if the dominant narrative on social media or some forum full of aggressive day traders is constantly insisting that your strategy is way too conservative? Listen, if any of these scenarios make you want to abandon your carefully laid out strategy, then your allocation is too aggressive for you, period. no matter how perfectly it solves those mathematical equations we looked at a minute ago. To really wrap our heads around this emotional tolerance piece, we have to totally rethink how we view stocks. The source material uses a really powerful analogy for this, and it's basically the perfect way to visualize the duality of risk and reward without getting bogged down in Wall Street jargon.
We need to treat stock investing exactly like we would treat fire. Equity is incredibly useful. In fact, for most of us, it's absolutely necessary to accumulate wealth over the long run. It provides the essential heat that grows our portfolio. But an over-reliance on it, letting that fire grow too large without proper containment, will absolutely burn your house down. This is exactly why so many wildly successful investors maintain a moderate stock allocation, rather than just blindly chasing the absolute highest stock ratio possible.
So, let's bring the math and the emotions together and look at some really simple starting benchmarks. But please keep in mind these are rough guidelines, not universally applicable laws of physics. Honestly, when you're feeling indecisive, it is deeply reassuring, and usually pretty wise, to start with a slightly more conservative ratio than you might prefer. Why? Because you can always increase your equity stake later on as you gain more experience and get more comfortable managing that fire.
So, if you are a beginner, if you're naturally cautious, or if you simply value a good night's sleep and stability way above maximizing every last possible dollar, a 50-50 split is a fantastic starting point. Think of it as the financial equivalent of a warm glass of milk. It gives you this incredibly balanced, sturdy foundation that won't give you severe whiplash when we hit sudden market downturns.
Now, for those with a longer investment horizon and a bit more psychological tolerance for market volatility, a 60% equity stake is a really solid middle ground. You're capturing more of the growth potential of that fire we talked about, but you're still keeping a substantial 40% in debt to act as a serious, heavy-duty buffer when things inevitably get bumpy out there. And finally, if you have a very long horizon, highly disciplined savings habits, and this is the real kicker right here, you have actually survived significant market drawdowns in the past, like the 2008 financial crisis or the 2020 crash, without panicking, then a 70% equity allocation might be appropriate for you. But remember, long-term success isn't about picking the perfect optimal ratio. It's about picking a reasonable one that you can actually stick with when everyone else is running for the exits. But listen, getting into these positions is literally only half the battle. You also have to know how to get out safely. Asset allocation isn't something you just set in your 30s and completely forget about until the day you retire. It is a living, breathing strategy. If you don't actively adjust your risk, you could face a catastrophic market crash the exact day before you plan to retire, completely wiping out your goals. You have got to continuously adjust and de-risk as you approach your target year. If your plan is to hold 60% or 70% in stocks, you have to decide right now, when exactly will you begin reducing that risk, what is the pace at which you'll reduce your stock allocation, and exactly what safer bond instruments are you going to use to replace those stocks. Without this clearly defined exit strategy in place, your current asset allocation plan is really only half complete. As we pull all of this together, we have to actively avoid some incredibly common pitfalls. Blindly copying an influencer's holdings, choosing your allocation purely based on your age, or mistaking the easy courage you feel during a massive bull market for your actual true risk tolerance. These mistakes will derail you. You also absolutely cannot ignore the hidden drags of taxes and inflation on the timeline for your goals. The absolute best practice is always to combine the cold calculation of your target return with rational, brutally honest emotional factors.
Because at the end of the day, it all boils down to this one incredible reality. A strategy that lasts 20 years is far superior to a so-called better strategy that you abandon after one crash. Remember, you can't discover your true risk tolerance just by reading articles or watching explainers. It has to be learned through enduring real market volatility over time. Your initial allocation doesn't need to be mathematically perfect. It just needs to survive the real world.
So I want to leave you with this final thought to really chew on. Is your portfolio built for a perfect spreadsheet, assuming you have the emotional baseline of a robot, or is it built for you, the actual human being, to survive a crash and stay the course? Take a hard look at how your current setup balances your financial math with your human psychology, and we'll see you in the next one.